Well, volatility is back. Over the last week, we've seen equities, we've seen crypto, both pull back from their recent highs. What's driving this? There's really a few things. One of them is the fact that expectations for the next Fed cut at their next meeting in December, they've actually fallen. So about a month ago, basically a 100% chance of the Fed cutting at that meeting. As we look at the Fed funds futures, and the market is pricing below a 40% chance of a Fed rate cut. And that's really because we've heard from a lot of voting members and non-voting members at the Federal Reserve talk more recently about how they're a little bit more focused on lingering inflationary pressures than they are the weakening jobs market. And so that could be spoiling plans for a lot of investors who are really prepared and hoping for additional monetary policy accommodation and support from the Fed. I think a lot of this could also be the fact that we're seeing for the first time a healthy dose of speculation when it comes to the artificial intelligence trade. We've actually seen a lot of these high-flying stocks pull back in recent weeks. It really started with Meta or Facebook. They're down a little bit more than 20% from their all-time high. And I think this is broadly a trade where a lot of investors are starting to question all the money that's going into the artificial intelligence build out. We've seen a number of these companies, these hyperscalers, have committed to spending over hundreds of billions of dollars per year on the AI build out. And the question is, when will they start to reap the benefits? When will they actually be able to show the benefits for all of this investment to investors, if at all? And so I think that has a lot of investors worried, especially as we know that their valuations have soared in recent years. We don't think that this is an AI bubble that's in the process of bursting here, but I think it's a great reminder of why we diversify client portfolios. We've been saying for a long time now that you can play this AI theme and have exposure to these names, and many of them are great companies. They're the ones that are printing cash and some of the most profitable companies out there. But you need to be mindful of how much risk you are taking on and how much these companies are accounting for your overall equity exposure in your portfolios, especially as they continue to outperform. Their relative weighting within your portfolio could become quite sizable. And so it needs to be managed appropriately. And so we diversify our client portfolios. And let's remember, even if you still want to play this artificial intelligence theme, there's ways to do it without getting over your skis and over allocating to information technology and these tech adjacent types of sectors. In the most recent earnings season, we're actually wrapping up the third quarter earnings season, but we saw over 60% of companies in the S&P 500 actually referenced artificial intelligence in their earnings calls. And as you look at the underlying sectors of the market, we actually saw that it wasn't just technology, it wasn't just communications. There's a lot of other sectors in the S&P 500 that are looking for ways to utilize artificial intelligence and reap some type of productivity gains and efficiencies out of this new technology. So the way that we look at it in our portfolios is you can have exposure to these high-flying names, but do it within reason. And maybe we are moving towards this next phase of artificial intelligence where it's going to be less about these high-flying names, these hyperscalers that are really focused on building out the infrastructure and looking for these companies that will ultimately benefit and be able to apply this technology. So there's a couple of ways to look at this when it comes to using AI and investing in AI in your own portfolio. As we look to what's on tap this week, we're going to be finishing up earnings season. So Nvidia, sticking with that artificial intelligence theme, is set to report on Wednesday. We're also going to hear from a number of retailers, specifically Target, Walmart, Home Depot. That's really important because we know that this economy is driven by consumer spending and this consumption. We know that confidence has been dented because of lingering inflationary pressures and a weakening jobs market. So when we hear from these companies, it really provides us with a look into how the consumer is actually doing. And so it'll be a really informative week for us when it comes to the economy. And outside of earnings, on Thursday, we're going to get the September jobs number. So this number, we are in November, so this number is actually coming about 7 weeks late. So better late than never. It's coming late because of the government shutdown. Now that the government is back open, we're going to get this number. So it's not going to be very timely, but it will give us a look at how the labor market was looking back in September. We'll eventually get that October jobs number as well. We won't get the unemployment rate because since the government was shut down, there was no one working and able to gather the survey information from households. So that'll actually be the first time since in about 70 years that we won't have an unemployment rate for the month of October. But again, it's good the government is back open. We'll start to get these data releases in a more normal fashion. And we certainly appreciate that. I know the Fed does, since we were all kind of flying blind there for a while. So I'm going to leave it there for this week. We're off next week due to the holiday, but I hope you all have a great Thanksgiving. I'll look forward to catching up when we return. And if you have any questions between now and then, please don't hesitate to reach out to your financial advisor.